Hello everyone, welcome to a on-chain market update for 17th of January 2021. So today we're going to run over just a little bit about what a Bitcoin top might look like. So we've done a previous session, it was a little while back now, but looking at buying the dip, where we looked at a number of different levels and tried to understand a little bit about what the probabilities were that price would get down to that point. And then you can essentially use those probability charts to buy the dip, which in a bull market is generally the right move. But what we saw during this particular rally is just the extreme strength that it came out with. So we really did see Bitcoin rally in a pretty spectacular way. And, people were getting to the point where, we have to start questioning, are we hitting some kind of overheated territory? And trying to balance the reality of what's going on chain, where we've been seeing a consistent withdrawal from exchanges, which is obviously quite bullish. We've been seeing, momentum in terms of how much value is being transferred on chain continue to go higher. Things like the NVT has been essentially trading sideways. So overall, the picture is very, very bullish. We've seen that very, very distinct shift in withdrawal behavior that really is signaling institutional interest in Bitcoin, but B, interest in it as a macro asset, right, in direct response to what is going on in the world today. And so all of these things are fundamentally very, very bullish. And what we probably need to start thinking about is what an actual Bitcoin top could look like. Because obviously we have a number of models and various price levels and probability curves and all this kind of thing that we've set up for BTC. And the question is, will they actually look like that as we run through, as this bull market plays out? Are we in a market where it is in fact going to break some of these models to the upside, or are they actually going to hold true? So, it is an interesting question. And again, no one can really look into the future and tell you what that's going to look like. But we can certainly make an educated guess and at least start mapping out what exactly a topping signal might look like. So we'll run through some metrics on check on chain and just have a look at what we have in our toolbox essentially. And then we can essentially go from there and just start looking at what some of these topping price models might look like, where they're all currently sitting and what kind of confluence we currently have going on there. So just before we do that, I will start off this pod by actually going through the podcast recommendations for the week. The first one is Hidden Forces, which is a recent one that was put out with Grant Williams and Ben Hunt. I realize I've written here Butt Hunt, so different guy. What they really do is they discuss the nature of narratives in honestly the crazy world that we're currently in. And it very much resembles a fourth turning type scenario. There's obviously a lot of chaos in society. There's lots of inequality. There's lots of broken trust in institutions. There's just many, many layers that are all coalescing in a very, almost at the same time. It's all about gradually, then suddenly. And there's no question that we are well and truly in the suddenly phase. So it's quite a sobering podcast. It's something that it certainly makes you think about the magnitude and scale of, I think, what is kind of in front of us all. And again, I'm sure none of us would prefer that the world be as chaotic and insane as it currently is. But it is, as Doc would say, this is the market that is in front of us. So using whatever information we can and trying to distill good ideas and perspectives and just getting ideas about how this is all playing out, what are the likely outcomes, I think is important. And I think that these guys in particular, Dimitri is the host of Hidden Forces, is very good. Grant Williams is very good, and Ben Hunt is, he's a wizard when it comes to understanding human narratives and how things are not really replicated in financial markets that they are in reality. So I certainly found it to be a very interesting and insightful podcast. And another one that I'm actually really glad that Pete McCormack did this one. So Francis Coppola is an economist who's essentially a Bitcoin skeptic, but is confident in cryptocurrencies at large. So Pete McCormack had, rather than people yelling at each other on Twitter, actually brought on Nick Carter to be the bat for the Bitcoin team. And it was a really interesting and intriguing conversation. I mean, it goes for something like 2 hours. And whilst I also don't really agree with many of Francis' perspectives, it is very interesting to see, a reasonably rational economist actually discussing the issue, right? Peter Schiff will say the same thing over and over again, and he just refuses to get it. Whereas Frances has actually gone through the process of fully, in her own, from her own perspective and experience base, coming to a reasonable understanding of how Bitcoin works, what it does. And I personally found it to be a really useful conversation to listen to. I certainly, continue to side with Nick on most of the points, but in general, it's a fairly good and civil debate. So it's worth listening to. And there is a part 2 that they're going to be releasing, or they have to record, but that they'll be doing, which is specifically on proof of work and Tether. And Tether's obviously been a fairly interesting conversation topic. There's been lots and lots of FUD floating around of late. My short opinion of Tether is that I actually think that most of the FUD is generally baseless. There's been a number of podcasts recently that if you are interested in listening to more about that, let me know. But I think I heard one of the best justifications for why Tether is probably not a Ponzi. There's a few things. One is you have major trading desks like FTX and many people who are in the exchange space and the big institutional space who have very, very frequent interactions with Tether where they are redeeming 1-for-1 for US dollars. So there are big businesses in this market that do use the service to come in, to go out. And, there is evidence that it is being used and redeemed as it says, right? Now, what the actual backings are, there's always been issues with transparency there, but to be perfectly honest, there's issues with transparency in all industries, whether it's legacy or cryptocurrency. I mean, none of the exchanges seem to be stepping up and doing proof of reserves. So, is Tether any less sketchy than any other business in this space or even in the world? Not really, in my honest view. And I think one of the most pressing things about Tether is if it was around in 2017, 2018, and very often if you have a Ponzi scheme and then suddenly the asset that it's supposedly backing or is being backed by or whatever goes down 80%, right, from 20,000 down to 3,000 for BTC, normally Ponzi schemes explode, right? They implode under that kind of sell pressure, and Tether seemed to have no such signs of that. So it does have it's got a Lindy effect. It's got a level of market trust, clearly, because of its magnitude. So I'm certainly looking forward to it. I know Nick has done a very, very large amount of research on Tether, probably more than most people, and he seems fairly unfazed by it. And I think the debate on proof of work will be very interesting because that's a very misunderstood concept. Everyone looks at it boiling the oceans, but actually most miners are using stranded energy or wasted energy that would otherwise literally go nowhere. So I think that'll be an interesting debate, and I think this is a really good one to listen to, just to always get a critical perspective on things from people who are well versed in the matter. So let's get into the fun stuff. Let's jump into our topping metrics. So most of the time when we jump into check on chain, we'll jump into things like the Mayer multiple, realized price, things like that, where we've got our probability bands. In general, those probability bands will continue to work, and let's just, for completeness sake, let's just start with our Mayer and our MVRV. And you can see up here, this is when we're getting into our 5% range. So in all of our metrics, we've used 5% being a pretty unlikely event. You can see that it basically picked up, not necessarily the whole move, right? It punched through on all of these occasions, except for 2017. Very likely we'll have something that's more smooth like this. You can see that these are very, very spike, very, very young protocol at this point in time. Gaining traction at a great rate of knots, so it's going to pierce through all these things, and plus we don't have the trading data to build these models up at that point. But you can see that we've got our Mayer multiple and our 200-day moving average now curling up. So this is now at 52,000 and clearly is accelerating. If we get a bit of consolidation, and you can imagine if this thing was to trade sideways, this metric would start to catch up, the 200-day would start to catch up, this guy will keep trending higher. So I personally would love to see some sideways price action for maybe a month, right? Give us one of these consolidations, just play out up here. That would be great. Bit of a pullback just to kind of unwind some of the energy and some of the leverage, and I think that's happy days. But overall, I think we could get an accumulation period here, which would be ideal. But in terms of picking tops, you can see that obviously our 5% band is normally a point to start paying attention. On the Mayer base, we're up here at 52,000. In the MVRV ratio, so I actually think that this has got a little bit more weight to it because it's an on-chain metric, and what we're seeing here is an acceleration in our realized price, right? The gradient of this guy is starting to turn upwards, And if you recall our early bull market, when it's disbelief phase, right, we don't have that many old coins moving. When you get these steeper portions of the curve, it's because coins that were bought back here are being moved to be sold. So this here is telling me that, and you can see this is actually a bit steeper than what we had back here. Some of the coins that were bought somewhere in this realm, or, sorry, to be honest, coins that were bought anywhere cheaper than that. But more importantly, the grading of this means that a coin isn't being priced from 38,000 to 40,000. It's being repriced from 3,000 to 40,000, right? The bigger the change since it was last spent, the more up tilt you're going to get in this particular metric. So that's essentially what's going on here. You can see that we're up into 48k was our 5% range, which we're starting to consolidate up in this realm. Again, as the realized price keeps moving. So interestingly, if you actually think about what this means, if more people move their old coins to sell into the market strength right now, this realized price is actually going to keep going up, and it's actually going to push price down, which is kind of what we would expect, but simultaneously it's actually going to lift our strong sell level, right? So all of our realized price will continue to go up because it's taking the sum of when coins were purchased and moved, when they were purchased, moved, and then when they're now moving again, what are they being repriced by? So if old coins are moving to sell, right, that's actually going to push price down, which will deleverage this system, and actually, but at the same time, our realized price will go up, and that will push our top model even higher. So again, kind of a similar concept to our chop index. You actually want pullbacks or sideways behavior whilst some of these old hands sell into strength, because that will actually give the market more time to breathe. You unload some of those coins, you get a reaccumulation phase, and then we move on for the next leg. So all in all, positive on that front. Now, a useful model actually is, in this instance for looking at tops, is actually the stock to flow model. Now, what I do like about the stock to flow model, so let's just look at mine for now, just to simplify things. Hang on, where is it going? Sorry, I'm just trying to turn off this particular purple line here, stock model plan B. Oh, strange. Okay, so I've got to fix my legends. Sorry for that. So what you can see with the stock to flow model, and what I do like about it, is it actually maps out. So you can see here where we had the repricing from the halving, and then it basically forms this price floor, because your stock to flow ratio doesn't change very much over the actual halving period, and then it obviously doubles, right? And then it trends up slightly because it's still releasing coins at a rate. So the stock is changing, the inflation rate is changing. So you do get a slight gradient through here, but in general, it's more or less somewhat static, right? In Bitcoin terms, we're talking about starts at 70,000, ends at 85. What's 15,000 amongst friends when it comes to BTC over a 4-year period? So what I like about it is it tends to set a floor price for the bear market, right? So you can see that the stock to flow model, and obviously that you can see the gradients are higher when you've got fewer coins, and it's actually going to start leveling out more and more over time. But you can see that in each of these instances, the stock to flow model really did set a floor price, right? And when you actually map the stock to flow model against the realized price, they're actually not too dissimilar. You actually get fairly constant, a fairly good correlation between the realized price and stock to flow, which is, it does make it a useful tool. And you can see that at the end of a bull, it really does overshoot. I mean, we went to 20,000 here and the stock to flow was saying 3,000. Yep. We went to 1,100 and it was trying to say 100, right? So that's a 10x move above where the bear market floor was. So you can see that in terms of where you would peg our current rally, we're somewhere around the halfway point. Yep. Because the full way point is going to be up here at 75,000, or under the under Plan B's model. Now let's turn these guys back on. He's saying up here at 120,000. So, and just to give you the delta, the difference between these two, Plan B's is obviously his original formula. My model is the same method he uses, but I use every single day data. I don't use a single day on a month. I use just every day. So it recalculates all the time. And mine's currently sitting here at R squared of 0.9. If you run Plan B's, it's more or less the same. So what we're, we would expect this to essentially overshoot to some extent. Now, the stock to flow multiples we've got to in the past is 7.8, right, at the peak. We got 17. So, these are non-trivial. This is basically saying it's going to be 17 times higher than where it was. Again, this is the early phase of our market, and you can actually see that the stock to flow was, there's this funky little dip here, which would have had something to do with mining changes, probably ASICs coming online. And, you've got this one here, which is 7.8. You can see up here, we got, what is that? 22 or 20 something. So you can see we're getting this lower highs over time. So perhaps we come in and we top somewhere around, 4, maybe somewhere between 4 and 8. So that would give us, if you take 4 and 8, what's that? 200. If you take 4 times that, 4 times 70 is going to be 280,000. I would not be surprised if 280,000 is, if I was to throw a dart right now and hope that's where it landed, that's my kind of gut instinct for this cycle, to be honest, is about 280. So that would largely map in with a peak, a stock to flow peak that's pretty much the same as this level here. Or our local top back here at 14,000. So you can't snuff it at 280,000. That's a pretty good result. So that's probably something I would be looking at, is certainly the stock to flow oscillator, using these pricing bands. And I would in particular just be conscious of somewhere around a level of 4, because every man and his dog is going to be looking at this model. And the nice thing is that every man and his dog is going to be looking at Plan B's model. Yep. And, that's fine, because Plan B likes to make his numbers pretty big, right? He'll use whatever data tricks and fudge factors he can to make it as big as possible, which is good for us, right? If you're along for the ride, that's good news. So I think this is this particular oscillator, and you've got both his and my oscillator set up here. I would consider that whatever this price here is probably going to look something similar to before, where it's kind of our bear market floor. So if this is our bear market floor at 75,000, 80,000, then we're going to overshoot that by some distance because of the euphoria that comes in. So that's probably a nice framework to be thinking about what a market top could look like in this instance. If we look at the investor tool, I quite like the investor tool. So I've set this guy up to be, if you are long-term looking for accumulation and sell the top levels, this is a tool for you. So we've got a few models here. One is in the blue and pink, is basically just the 730-day moving average. So it's basically the 2-year moving average, and then the top signals and multiplying that by 5. Just for, it just seems to work, right? So the pink zones is essentially where it would otherwise be a prime accumulation phase. Anytime it's under the 2-year moving average, great time to be accumulating en masse. I've got in here our 200-week and 128-week as those bottom catching signals as well. Remember, 128-week is accumulation like the realized price. 200-week is catch the wicks, right? That's generational buy level. We've got the delta price, which is an on-chain metric that looks at the difference between the average price and the realized price, and again catches the very bottom, the wicks of these bear markets. And then we've got the top price, which is essentially, it's 35 times the average cap. So if you took the average of all price history, and then you multiplied that by 35, which is, this is a number that just seems to catch these tops. You can see it's gone 1, 2, 3, 4. So the top price is currently sitting up here at 83,000. Because it's mapping off the average price, it's the average. I mean, if you take the global average, it's taking everything from 6 cents, 12 cents, $2, $100, all the way to 40,000, right? The more time it spends at high prices, obviously, the more days it's going to be accumulating high value. So the top price will move the longer that we spend time up here. But it's obviously a slower metric because it's trying to overcome 12 years of cheaper price history. Yep. So the average cap is being influenced by how many days it's over that particular price. So, we've got 50,000 up here as our investor cap level, which again, you can see that it does in fact overshoot that. So, and you can actually see we've got a bit of a pricing band here. So it could very well be that it gets above this 50,000, which is also the point when it becomes $1 trillion asset class, and it opens up the realm for a whole new realm of investors. And what we could then see is a move up to 83,000. So you can see that this top cap is actually not too dissimilar to our stock to flow model, even though we said our stock to flow model is a bear market floor. What that's telling me is that it's likely we're going to get some kind of sideways price action, or at least I hope we get some sideways price action. or we could get what Willy Woo calls the double pump, right? So you could get a rally up, hit the top price, get a little miniature bear market, which again is that sideways price action. It's just in a different form, or following a different event, and then we get a second move up. Very possible, right? So these are the types of things we can start mapping out. If we do get above this 2-year moving average times 5, we're starting to get into some real, topping territory. And we know we've got our top cap up here, which who knows, it could get blown out to the upside. But again, there'll be a lot of people who, are moving markets who would, in general, most of these on-chain metrics, whilst they're, they could be a simple factor of 35, the fact is human psychology is fairly consistent. So we're using empirical evidence to map against things that we generally know are pretty accurate, right? The way that human beings behave when money's on the line. So one thing I did want to just, in the short term, let's just have a quick look at our market realized gradient oscillators. A bit of a mouthful, and you really need to shrink this down to something more digestible. But you can see that we had this very, very large impulse upwards. We saw these heightening peaks, and it basically went from increasing peaks to, a huge blow off top level peak, which we really don't see very often. And you can see that through all these previous bear markets, we had a fair bit of shake and bake, right? We need a bit of oscillation up and down. And what I'm kind of hoping is that we do, in fact, get a little bit of shake and bake here. And you can see that you can use technical analysis on this. We actually do have a head and shoulders that's playing out or has played out. So if we do actually get the delta gradient break below 0, you can see back here we had a little head and shoulders that essentially reverse back to the upside. We've now got a much larger one that wants to point down. We really haven't had anywhere near enough downside at this point in time in this bull market. So I would not be surprised if we don't get a nice little correction to the downside. And again, all of these things are going to be net positive overall for just the general health of the market and allowing many of these metrics to essentially recharge over time. So just keep an eye on that, particularly if it breaks below. This guy will go red if it does happen. But this is a nice one to just understand whether we have that momentum. And again, just be careful that we can get these little reversals and kick back to the upside. Might be a good little tool if you get a nice confirmed break above on the reversal, that it's starting to look more positive. And again, this doesn't have to be at 0. This could be down here somewhere, right? You could get your head and shoulders, and then it's starting a trend back up. So if we look at some mining metrics, which are generally pretty useful because miners are, really, they're the security system, they're the supply side. There's a few different layers to all this. So let's look at our block subsidy models, and we'll look at our pure multiple as well. So with the pure multiple, what I like about the pure multiple is that the peaks tend to be fairly normalized, right? Our bottom levels tend to hit the same point. So what the pure multiple is, it looks at the 1-year income. So this is a daily block reward in USD for miners. And then the blue line is the 1-year moving average of that, right? So what is the average income for miners over a period of time? And you can see that on average, we basically set these plateaus through the bear. Then we get these repricings, then it plateaus, then we get a repricing. So what's nice about it is because it's the 1-year moving average is relatively, it moves fairly often. Plus we get the halvings that kind of reset things and deleverage miners, and difficulty adjustment re-leverages and deleverages miners all the time. It's a fairly consistent metric. And you can see that our tops, we basically get up into this zone quite consistently. And that's normally our actual tops. And then our accumulation zones are equally very, very reliably touching those floor levels. So I like that it's very much a range-bound metric because the moving average is fast enough, slow enough to be important to be, giving a good view on what miners' income is. But overall, it's faster than, say, the 200-week moving average. So it's a little bit more reactive to what's going on. So you can see we're getting up into the zone where it's probably, time to be just cautious, the 10% range. But if we look at here, we're at 2.6, and our 5% level is 5. So that's essentially a 2x from here. So we're at 40,000, and that would put us up to somewhere around 80,000. Yep. So that's not this. In fact, that is where we're at with our stock to flow model. That's where we've got a few different metrics. Our top cap is up there as well. So there's a few things that are all pointing to around 80,000 as being a non-trivial level where if we don't get a sideways price action, it could be the point of the double pump, right? So we could very well get maybe it's an 80,000 to 100,000 candle, right? One of these crazy kind of candles that then blows off. That could be the range we talk about with our double pump. You know, we've got our top cap and our investor tool that we can use to try and maybe band that. But perhaps we do get that maneuver up to that realm. But there is something going on around 80,000, 80 to 85,000. That's giving us a number of metrics that's looking at, could be a local top. It could just be a rest spot, or it could be an area where if we get some nice sideways consolidation from here, and many of these metrics catch up, we can start getting a lifting in all of those levels, and perhaps it does go beyond that. So I think they're probably the two scenarios to be paying attention to. And similarly on our block subsidy model, so block subsidy, this is basically the thermo cap, or the cumulative sum, every single block reward that's been paid out to miners in USD terms, right? So you can think about this as the total cost of production. How much does it cost, taken to actually build up BTC? This is normalized back into a pricing model. So this is saying that our price, almost our total cost to mine BTC is at $1,169. And that's obviously because we've got lots of coins that were mined, 50% of the supply was mined at nothing, right? So that's really why it's so low in this instance. But what we can do is we can take multiples of that, right? So I've gone 2 times, 4 times, 8 times, so on and so forth, up to 64 times. So you can think about this as how much monetary premium has Bitcoin attracted above its cost of production. The blue line is the cost of production. This is saying that, back here it came back and tested its cost of production in the first bear market, rallied up and away it went, hit 64 times. It also hit almost 64 times back here, and then crashed down. And the bear market was set, the floor was set back here in 2015 at 2 times the cost of production. So it's essentially doubled its monetary premium, right? It's then rallied up, hit 64, rallied back down, and again, the 4 times thermo cap, it's now got 4 or 4.5 times its monetary premium that's now baked into the protocol. So I would suspect that our next bear market floor price, and I would not be surprised about this, comes somewhere up around the 8 times. So maybe we rally up to the 74,000 level, the 64 times. Obviously we can break through it. In fact, none of these we've actually broken through, which is kind of interesting. Maybe we get to this 74 level and tap it, and then reverses back down. Maybe something down here at our 8 times level. Now this will obviously continue to curl up over time. Maybe that sets the price floor at the long end. Maybe at the end of this cycle, that's kind of where the whole, after the bear market fully shakes out, that's where it kind of cashes in and levels out. But this is giving us another metric up here at 74, so it's a bit lower than the others. But again, things can overshoot. But it gives you a bit of a mental model from the cost of production perspective as to whereabouts a topping level could be. So you can see that there's something going on between 75 and 85,000. And we'll look at one last metric. So these ones that I just added in. In fact, we'll have a look at our cycle charts too, because I think I always find these to be very interesting. And I reformatted these so they're a little bit more useful. So we'll finish up on our Metcalfe law models, and for now let's have a look at our cycle models. So this is basically price performance since the capitulation point back in December 2018. And you can see that we started our rally off not dissimilar to our double pump back here, and this was the 2012 rally. You can see we started with the same level of acceleration. We then mapped back down onto the 2016-17 bull, and now we're pushing back up again. So, both of these two moments of, these are high enthusiasm events, right? This is early price discovery. This is early monetization back in the up to 2013 peak. This was more of a speculative bubble, and more hedge funds and people are getting involved. But the acceleration of both the rally back in 2019 and then the rally that we've just experienced, you can see that they're basically outpacing the 2016-17 trend. So that's relatively bullish. That is showing that there is now a paradigm shift. There's new money coming in. There's new excitement. And what's really good about this rally is that it's actually holding the gains, right? So it's actually maintaining that growth from that cycle low, which is pretty good to see, right? It's a resilience in the market. Since our market top, you can see that we're in orange. You can see we're, again, fairly similar. We tracked both of those bear markets. We've broken above all-time high, and we've actually done it with a little bit more gusto than what we did back in 2016-17. And price performance since the halving. So if you look at it since the halving, we're tracking basically halfway between the 2012 rally and the 2016 rally. So again, we're kind of within bounds. It certainly is positive, but you can see that there's a similarity between this peak. There's a similarity starting to look like this peak, and a similarity with this peak. So, we're in this same realm. It makes sense both on a time perspective, on a magnitude of gain perspective. There's a few things saying that we're probably going to get some kind of pullback. But again, if we were to rally, from here to, what are we at now, 4 times? So that would mean if you went to 8 times, that would be a 2x from here, right? Because it's 8 times from the bottom. So to 2x from here, we go from 4 times to 8 times. So if we do get up to the 80,000 realm, we will be in the same realm that we got this big pullback for in the first rally back there. So just to finish off on, this is a new and somewhat experimental model, but I'm calling them the Metcalfe law. So Metcalfe's law is essentially, the more nodes and things that come active, the more users that enter a system, you get basically exponential growth, or to the exponent of that many people coming in. Every node that connects to another node creates additional value in the whole system. So what I've done is run the same kind of analysis that we do for the stock to flow model, this log regression law. And it just looks at what kind of fit you get. And I've run it for 3 different things, which I think represent kind of people using the network for what the intended purpose is. The first one in blue is transaction count, right? More people using the chain, literally sending transactions, is going to have a positive growth on value. Active addresses, because the more people who are creating new addresses and moving coins around is obviously users demanding block space. So it's kind of similar to transaction count, but a little bit more, it'll capture more things like exchanges doing batch addresses, right? A transaction count could have many transactions in it. Address count will pick up that model a little bit better. And then another one, which, you shouldn't be surprised, has a better correlation because it has price included in it. So it's not technically the best model, but it's also the right one to be looking at, is how much USD value is flowing through the chain. Because if we're using BTC as an ultimate settlement layer, it makes sense that you'd want to be looking at how much value is being settled over time and use that as a metric for utility, essentially. So what the story is that I kind of want to bring up here is quite interesting, and I think it's that transition between, are we seeing retail or institutions? So this is a bit of a theory that I have. I think that it's probably pretty close to true, but this is the general gist. So you can see with transaction count, a transaction count model, we have 88. So these are all 88, 97, 96. So reasonably good fits. Transaction count having obviously the least. Now you can see that this is more or less plateaued. Now that's more or less because transaction counts are always going to be limited by block space. So through all of Bitcoin's history, it's been growing, right? If SegWit's been implemented, there's been all sorts of things that have allowed more transactions to fit per block, right? Making them more data efficient and more space efficient. Now, eventually we're going to hit full blocks. Yep. So at the moment, an average block is around 1.3, 1.4 megabytes. Because only a portion of the network is using SegWit. If 100% of the network was using SegWit, you'd be able to get 2 megabyte blocks, and then that would be the cap limit. So we're going to get this plateau because you can only fit so many transactions in 2 megabytes. So over time, if Bitcoin does continue to be adopted and used, and blocks are full, which they need obviously for the fee model, then this model will eventually break down over longer and longer time frames because it's going to be capped by a technical limitation. But nevertheless, what this is telling us is that we're not getting as many we're not getting a huge jump in transaction counts. Yep, so just keep that in mind. We are getting more of a jump in active addresses. So that's going to be a symptom of people doing batch withdrawals, because when lots of people send their coins to an exchange, they go to the exchange's address, right? So there's many people becoming one address. So you're actually shrinking the pool of active addresses. Conversely, if you've got lots of people doing batch withdrawals, that's going to create many more addresses. So you can see that we've got an increase in that, but it's also not mooning, right? It's not going super high, Obviously, there's going to be limits in terms of people that are actually able to get into block space. But when you map that to the amount of USD value, which is clearly trending very, very strongly, that means that lots and lots of value is flowing through the chain. It's what we've seen with the NVT ratio, where the NVT's been going sideways, and that means that the amount of transaction volume is justifying the price. They are matching each other, which is good. But what that's telling me, few transactions, some batch addresses, but huge value. That is high net worth individuals and institutions, right? Few transactions, high value. So that's what I think this is really telling me between this story, is that we do have withdrawals going on. This active addresses is a blend between retail and institutions, but this purple one is telling me that the amount of value that's flowing through the chain is millions of dollars on a daily basis, right? Many millions of dollars. I think it's almost up to, I think it settles something like $1 billion a day, right? But we're talking about $1 million transactions, people investing 5, 10, 15, $100 million, and then putting it essentially into cold storage. So, this is the macro backdrop that I think Bitcoin's in. This is the story that I think these is telling us. So, it's going to be interesting to see how it does play out. But over time, obviously the blue one will break down more. Active addresses will be the next one to break, and then transaction volume will always be relatively good fit. But we should be able to see when transaction volume really falls off a cliff and we get a breakdown in the NVT ratio. Could also be a signal that we're getting into some topping behavior. But anyway, there's a lot in that one. Hopefully, most of it sinks in. If you have any questions or you want to talk about any of these metrics in the chat rooms, you know where to find me. And otherwise, I will catch you in Discord. Have a good week. Cheers.